Born in 1962 in the heart of New York City, Jefferies has emerged as one of the well-known equity research firms. And recently, they have been researching Indian equities a lot. And they have released their stock picks for the next 5 years, a total of 11 stocks with price targets. So today, we are going to have a look at the strengths and weaknesses of some of the companies, each from a different industry. And one of these companies is really interesting. So let's begin. Namaste and welcome to Retail Investing. The first company does business in the RAC industry, refrigeration and air conditioning. Let's have a look at the chart. All these red candles are a bit disturbing, but some sort of recovery has already begun. The RSI is at 50. On Friday, the 22nd of March, the stock price went above its 200-day moving average. Overall, the technicals indicate a neutral trend at best, but trends change very fast. So what exactly does the company do? Well, ACs require some critical components like heat exchangers and printed circuit boards. Amber Enterprises supplies them to the AC manufacturers. In fact, among the OEMs of the refrigeration and air conditioning industry, this company is the market leader with 70% market share. The demand for ACs is going really high. According to the International Energy Agency, AC ownership is expected to grow faster than all other home appliances. But if we look at the stocks of some of the AC companies, they are not doing that well. Here is the chart of a well-known AC stock, Voltas. If we look at the past 2 to 3 years performance, it has not created any wealth for investors. In such scenarios, companies that provide components to the AC manufacturers makes sense for investors. So here is the financial overview. It's a small company with a market cap of just around 12,000 crore rupees, and there is plenty of room for growth. According to Jefferies, this company's earnings growth is expected to compound at 36% every year until 2030. Now that is some massive growth, but it's a B2B business, and that brings a problem. Let me show you. So here is the cash flow statement of Amber Enterprises. As you can see, the company's profit from operations have been growing at an impressive rate, but it is not converting into incoming cash flows. The receivables are very high, so that is a weakness for this company. It is India's second largest cement producer. And here is the chart. The current market price is 589 rupees. The 200-day moving average is at 500. Looking at the volumes, the RSI, nothing exciting is going on. The trend is almost neutral. It might look boring, but something exciting is happening in the financials. So here is a comparison of the profit margins of India's major cement producers. This blue dotted line is our company. As you can see, the profit margins hit rock bottom in the third quarter of 2022. But then something happened. The company was acquired by the Adani Group. And since then, the profit margins have been sharply improving. And the main reason for that is reduction in costs. This deep blue line represents the fixed costs of Ambuja Cement. Now the costs are one of the lowest among the peers. Using green energy has improved efficiency and reduced costs. It seems Ambuja Cements is in a stronger position now compared to its peers. The strategy is simple. You use solar power and your electricity bills come to zero, almost. And due to non-stop construction activities, highways and buildings, cement demand is going up very fast. So it's already a large company with a market cap of more than 1 lakh crores. And it's a free cash flow positive company, which is always great. You see, free cash flow is the best kind of cash flow. It is totally free for anything to be done with. But there is a problem. The Adani Group is infamous for related party transactions. It's totally legal but not desirable for investors. If I invest in Ambuja Cements and its free cash flows are taken out and put into Adani Enterprises, I would be disappointed. So this company is from the energy sector. So here is the chart. As you can see, the stock has gained massively since June 2023 and the trading volumes have been quite high since then. There is clearly some interest in the stock. The company is in aggressive expansion mode. In the next 2 years, 80% of its capacity will be from renewable energy. Energy storage technology is going to play a big role in the future to solve power deficit problems during peak times. This company is the first one to heavily invest in solar power battery storage and hydro pump storage. So here is the financial overview. It's a fairly large company with a market cap of 80,000 crore rupees. It is also free cash flow positive and that is nice. Now please note that the price to earnings multiple is more than double the industry average. According to Jefferies, this company is expected to trade at higher price to earnings multiples in the next 18 to 24 months and that is due to higher growth expectations. So JSW Energy is actually the holding company for the power sector businesses of the JSW Group. Overall, I feel bullish about the power sector, but when it comes to JSW Energy, I'm a little bit worried about its current price. Investors can gain if the P/E ratio continues to remain inflated in the future. So this is a PSU bank and a Fortune 500 company. And here is the chart. The current market price is just under 750 rupees. The 200-day moving average is at 618. The volumes are always strong. Apparently, it is a very interesting stock. Something is always happening in the chart. So the return on equity is 16.8%, which is just okay. The price to book value is under 2. For comparison purposes, let me say that HDFC Bank's price to book value is almost 3. The lower it is, the higher the growth opportunities. So according to the research by Jefferies, two things can make SBI go up 2.5x from current levels. Number one, the bank is capable of raising more capital and they can give out more loans, and that is how banks make money. And number two, the stock can get re-rated. The price to book value we just talked about, it can go up. Now for SBI, the short to medium term price targets are being given around 900 rupees. So please keep that in mind before buying. The long term price target given by Jefferies is 1860 rupees, 2.5x returns from current levels. That's nothing extraordinary but decent returns. The PSU banks have improved a lot in the last 10 years, but still they lag in the use of technology. HDFC Bank, which is the largest bank in terms of market cap, has set a completely different vision for the future. They plan to become a tech company which is into banking. Is SBI even thinking in that direction? I don't know. It is a real estate company, the famous Lodha Group. And here is the chart. The stock has almost tripled in the last 12 months. The price to earnings multiple is 67.4, a huge premium over the industry average. And I'm sure that has something to do with the company being free cash flow positive. One thing to notice is that the quick ratio is quite low. It basically means that the inventory stock is high. A lot of unsold flats. So is there anything special about this company? Well, they have a large land bank in the suburbs of Mumbai. How large? 600 million square feet. Mumbai is expanding really fast. All these suburbs are witnessing massive infrastructure development. If the price of this land goes up, investors are going to make money. In Peter Lynch's bestseller book, One Upon Wall Street, this kind of stock is called an asset play. So this is the most interesting stock from the list. It used to be mainly a food delivery business and now it has almost become a quick commerce business. And in future, it is expected to become an e-commerce business. And here is the chart. This stock has been a massive multi-bagger since February 2023, from 47 rupees to 170 rupees, 3.6x returns. So here is the overview of the profit and loss statements. 4 years ago, the per share loss was 70,000 rupees. Today, it is zero loss. The sales are growing very fast, but the expenses even faster. The company's focus is clearly expansion, and all the expansion activities are being done with negligible debt, which is very good, and the reserves are huge. So, is it a clear green signal for retail investors? Well, most people did not believe that a food delivery business can be a profitable one. But Zomato proved us wrong. Then there were big doubts over the quick commerce business model. Zomato's Blinkit proved us wrong again. Now they have plans to take on big e-commerce companies. Well, e-commerce companies are not the best option for stock market investors to make money. But maybe Zomato will prove us wrong once again. But as retail investors, we need to have some idea about the company's future cash flows. If we cannot get the idea about the company's future business model, there is no way we can estimate the cash flows. According to the CEO of Zomato, their goal is to create disruptions in various industries. Price targets as high as 265 rupees have been given for the Zomato stock in the short term. The 5-year target given by Jefferies is 400 rupees. Now, I am very interested to see what happens to the Zomato stock price after the Swiggy IPO happens. We keep hearing about so many stocks from so many analysts, but we should invest only in those stocks which we understand, because it is going to be a long-term commitment. It's our life. We are going to live it our way, and we really need to filter out the noise. I'll see you soon. Jai Hind.